colleagues and guests. On behalf of UNDP Ghana, I am delighted to join you for this important gathering of actuarial professionals advancing Ghana's financial resilience agenda. We are particularly proud of our collaboration with the Actuarial Society of Ghana and Milima under the UNDP ITFF Global Actuarial Initiative, through which we jointly supported the development of Ghana's Assured Mortality Table. This national milestone is not only a technical achievement, but also a testament to the power of partnership in building local capacity and evidence-based solution for risk pricing and insurance inclusion. UNDP remains committed to deepen its collaboration with the ASG and industry partners to strengthen actuarial science, improve data ecosystem, and advance inclusive insurance and risk finance as key pillars of sustainable development in Ghana. Congratulations once again, Ayiko, to the Society for this conference and for the leadership you continue to provide in shaping the future of Ghana's actuarial professionals. Thank you.
Thank you very much. We will want to take a remark from the representative of Africa Re. Please, a round of applause, Africa Re.
Good morning, distinguished colleagues, regulators, actuaries, industry leaders, and development partners. It's a great honor to represent Dr. Corneille Karekezi and the Africa Re Group at this important gathering of the ASG. Being Ghanaian and an actuary myself, I was delighted to come when he asked me to represent him. Dr. Karekezi would have loved to attend, and he has consistently shown his support for the actuarial profession, both through financial support and through giving his own time to actuarial events. I convey his apologies as well as his support for the conference. I begin by commending ASG for choosing such a relevant, forward-looking theme, strengthening the actuarial foundation for a resilient industry. This theme speaks not only to Ghana, but to the entire African financial risk, insurance, and broader financial services ecosystem. Across the continent, we are operating in an environment of rapid change, economic uncertainty, regulatory evolution, technological transformation, and the growing complexity of risks from climate to cyber and AI to health and pandemics. In this landscape, resilience, which is the ability to adapt, to absorb shocks, and to emerge stronger, is not just desirable, it is essential. And at the very heart of that resilience lies actuarial strength, the science, the discipline, and the people who give our industry the credibility and confidence. When we speak of an actuarial foundation, we're referring to the analytical infrastructure that supports sound decision-making across financial services. This means the data, the methods, the standards, and the professionals, I keep coming back to people, it's important, that enable organizations to manage risk protection, protect value, plan for the future, and honor long-term promises. Actuaries turn uncertainty into insight. We're comfortable operating in areas of uncertainty because that is what we were trained to do. We quantify risk, measure volatility, and equip management with the tools needed for evidence-based decisions. Let me take a moment to highlight the importance of insurance in Africa, especially in an era where climate change is accelerating and natural disasters, including severe flooding, which we experienced here in Ghana, are becoming more frequent. Sovereigns across Africa are entering what may be described to as a climate debt trap, where they are forced into a cycle of borrowing to address climate shocks. This is precisely where a strong, well-capitalized insurance sector should step in. As UNDP Administrator Akeem Steiner put it, protection from risk is the only way out of a world of deepening inequalities and compounding crises. Exceeds supply. To illustrate the gravity of the situation, South Africa represents the market in Africa with the highest penetration. It represents about 60% of total insurance premiums for Africa. They have lots of actuaries in South Africa, yet they often cite actuarial shortages. And there are nearly 2,000 credentialed actuaries in South Africa alone. Credentialed. For the rest of Africa, this number is only 200. So only 1/10 of the actuaries that are in South Africa. The gap is stark. Many markets therefore rely heavily on external consultants or important assumptions. That dependence limits local innovation, slows decision making, and prevents the industry from fully reflecting its own realities. Building actuarial resources is therefore not merely a capacity issue, it is a strategic imperative. I think I heard one of my colleagues say that earlier as well. It is about producing more actuaries and ensuring that these actuaries are empowered, connected, and supported by credible local data. So why does this matter so much for resilience? Because a resilient insurance industry is one that can anticipate risk, absorb shocks, and adapt to change. Actuaries play a central role in each of these stages. Before a crisis, they model emerging risks, inflation, currency volatility, longevity, climate patterns, helping companies anticipate exposures and to put appropriate measures in place to be ready to deal with those risks when they materialize. During turbulent times, actuarial insight guides management responses, ensuring solvency and protecting policyholders. And afterwards, actuaries help the industry learn and rebuild, recalibrating assumptions, rebuilding pricing and reserving frameworks for the future. In this sense, actuaries are not just number crunchers, as we love to be known. They are risk architects and strategic advisors. As Africa's insurance and financial landscape matures, our role must continue to expand beyond pricing and reserving into enterprise risk management, product innovation, sustainable finance, and inclusive insurance that reaches the most vulnerable populations. Strengthening actuarial foundations is ultimately about people. We build people, not just models. They convene professionals, as we're doing here today, cultivate a community of practice, and provide the platforms through which knowledge, mentorship, and standards can grow. It is also why Africa Re invests continuously in actuarial development. Through partnerships, research, and initiatives like the Africa Re Foundation's support of the Assured Life Mortality Project. Allow me to highlight this initiative briefly, as I know we're all very proud of it. The Assured Life Maturity Project, led by ASG and supported by a multitude of entities. We've got the National Insurance Commission, the Ghana Insurers Association, UNDP, I hope I've not missed anybody, and Africa Re Foundation is a landmark effort. Africa Re Foundation proudly provided financial support because we believe this project embodies exactly what we support. Locally led, data-driven development. Africa Re is supporting similar efforts across several countries, not only in Ghana, but in Nigeria, Egypt, and others, because actuarial self-reliance is essential for long-term resilience. Ghana-specific mortality tables will improve pricing, strengthen market confidence, and position Ghana as a leader in actuarial independence. The era of using old UK life tables for our projections must end. Just like Ghana was one of the first getting political independence, let it be one of the first in actuarial independence. This is not just about new tables. It's about new confidence in data, in expertise, and in the future of the Ghanaian insurance industry. The lessons from this project, and many like it, is clear. When we invest in actuarial resources, we invest in economic resilience. With a strong actuarial base, our institutions can create relevant products, stay financially sound, innovate with confidence, and meet global standards without losing sight of African realities. For policymakers, actuarial insight improves national planning, pensions, and social protection. For consumers, it builds confidence that promises made today will be honored tomorrow. And for Africa Re, actuarial strength strengthens our partners, making the entire ecosystem more robust and competitive. So where do we go from here? First, we must expand the pipeline, more scholarships, stronger universities, and digital learning pathways. Second, we must deepen collaboration among actuarial bodies. Ghana is already a leader in diaspora-supported exam sponsorships with enviable pass rates, even on a global scale. This is commendable, and it should continue. But we can go further. Actuarial Association, hello Neil, the African Actuarial Development Academy, and the Actuarial Academy of East Africa are essential. They allow actuaries to share success stories, leverage networks, and scale proven initiatives. In this digital age, the opportunity for joint programs is tremendous. ASG should absolutely share its experience with other African countries. I'm looking at you, Mr. President. Thirdly, we must embrace innovation, integrate actuarial science with data analytics, AI, and emerging modeling, while I'm often replacing them. In Africa, with such a severe talent shortage, AI is an enabler, not a threat. We should be exploring how it could amplify our impact, not diminish it. And finally, we must invest in leadership. I heard one of our regulators say this, and I was so happy as well. Actuaries have the skills to contribute to every aspect of decision-making that involves risk and uncertainty. We need actuaries in boardrooms and policy discussions, offering not just calculations, but strategic foresight. Africa Re stands ready to continue this partnership as a reinsurer, a development catalyst, and a steadfast advocate for actuarial excellence across the continent. As we deliberate over the next 2 days, let us remember, resilience is not built by regulation alone, it is built by people. Yes, the people in this room. By actuaries, insurers, regulators, and partners who invest in knowledge, ethics, and collaboration. If we strengthen our actuarial foundations today, we will build an industry that is not only profitable, but trusted, and one that protects lives, supports growth, and contributes to Africa's sustainable development. On behalf of Africa Re and Dr. Karakazi, I congratulate the Actuarial Society of Ghana and all the partners on your leadership.
So kindly join me. Let's welcome Mr. Seth Aklasi to give us.
The theme is that we live in a country that a lot of things happen without necessarily having to be backed with the data and the analysis that we require to be able to make decisions. It's very, very important that as actuaries, you take over the responsibility of having to craft the narrative and the policy that has to be made as a result of the very nature of the work you do. The theme for this year's conference, nevertheless, just gives credence to that assertion. I wish you a very successful conference for the next 2 days that you are here. And as much as I wish I could learn a few things, something else is pulling me apart to be somewhere else. So I'm just here this morning. So you're all welcome to the conference and enjoy the next 2 days. Thank you.
Thank you very much, Mr. Seth Aklasi. we want to move to the intersection where data actually meets integrity. So at this point, we want to talk about using data analytics to combat health insurance fraud. And we are going to emphasize on the NHIA experience. So kindly join me to welcome Mr. Magnus Owusu-Agyemang and Marian Angela Tandorf of the NHIA. Please, a round of applause for them.
Everyone. My name is Marian Angela Tandorf, representing the NHIA. I have with me my director here. So today we want to discuss using data analytics to combat fraud in health insurance. There is this growing conflict between data analysts and actuaries. Everyone thinks they can do better when it comes to data. So there was once a joke. There was an analyst, data analyst, and an actuary in a meeting, and they were asked to bring up how to detect fraud using data. The actuary brought models. The data analyst said, "Oh, I can give valuable insights with my dashboard." The arguments kept going on, but guess what was happening behind? The fraudsters were hiding in the data set. With that said, I just want to highlight the fact that data analysts and actuaries shouldn't be working in silos, but together for, effectiveness. As we wait, the fraudsters are still hiding in the data set. I don't know if the screen is visible enough. So when you talk about health insurance fraud, what do we mean? It's an intentional act of deceiving and misrepresenting information that results in healthcare benefits being paid to individuals or groups. So why do we need fraud detection? Fraudulent claims threaten health insurance sustainability. Because every fraud inflates our claims cost, and that's going to affect our sustainability. Actuarial analysts must also understand fraud to accurately price risk and maintain financial projections. Globally, 3 to 10% of health expenditure is lost to fraud. Bringing it to our local context, that means for every 100 cedis spent on claims, 3 to 10 cedis is lost to genuine patients who need that money for healthcare. What are some of the scenarios we see under health insurance? It comes in different forms. We'll talk about the provider fraud. Provider fraud is when the health facilities or the health providers engage in intentional acts to either inflate our claims or for their own personal benefits. We have the member or beneficiary fraud, which is us seeking the healthcare using our health insurance. Some members actually do provider shopping, moving from one provider to the next provider, either with the same issue or just to acquire drugs to sell for their own purposes. And there's a collision fraud. That is when all parties come together to act on this fraud. So you can get a provider and a member coming together let me give an example of a collision fraud. So you get a provider prescribing certain medicines or inflating it to a different facility. This provider might be to a different facility, the insider that I've brought some claims. The insider can also give some ways where the provider can just glitch or something in the claims and proceed for vetting and payment. We see certain red flags as analysts that instantly prompt our attention that these are fraudulent area. That's very questionable. What are you looking for in the CT scan with malaria? Then there's provider shopping. This is where the member fraud comes in. When members move from provider to provider, probably because they weren't satisfied with the first provider and think the second one is going to give them better health care. Some also end up just getting the medications and selling them in their local communities. There is vague documentation on claims. If a pharmacy submits a claim and there is no linking documentation to where the prescription comes from, that's an example of vague documentation on claims. And contraindication, where there is drug, the child is probably prescribed medication with excessively higher strength, which is not good for children. Multiple claims for the same serving within and across facilities. We sometimes find providers submitting multiple claims. It's intentional. But they intentionally duplicate claims for more money, billing for more expensive services than provided. Thank you. Billing for more expensive services than provided. I'll use the pharmacy as an example. You take your prescription to the pharmacy, and maybe medications of equal strength, but one costs lesser than the other, and the pharmacy intends to give out the expensive one just so they have more claims or money out of their claims they submitted. But how do we do all this? We use these types of analytics for our fraud detection. And each step builds on the other. There's a descriptive analytics, which answers the question about what happened. This is where we use past data we analyze past data and visualize based on what happened, average cost per claim, total cost, IPD to OPD ratio. All this happens when you use the descriptive analytics method. Then after this, we want to know how this all happened. Why was 2024 claims lesser than 2025 claims? How come 2025 claims are having, say, 50% more than 2024? And that's when you do the diagnostic analytics. And we use tools like R, Python, process mining, etc., to dive in deeper to find the causes and relations with why this happened. So let's say 2024, our claims were about 100,000. In 2025, we have 250,000 claims. At the diagnostic level, we want to find how come our claims increased to 250,000. Then here, as we dive deeper, we realize that maybe Ashanti and Bono region submitted excessive claims. How come they submitted excessive claims? Was there something happening in these regions? Maybe there was an epidemic. Maybe there are some providers who are actually inflating their claims. We want to find out why this happened to be able to project, and that's when you get to the predictive analysis. So predictive analysis is when we project to know what's likely to happen next. So if there's an epidemic in Ashanti and Bono region, does it mean that for the next 2-3 years, if this epidemic is not solved, we are still going to have this number of claims or more? But if there's actually no genuine epidemic and providers are actually submitting fraudulent claims, we want to know what is happening in that facility, and if there are any measures to take, we take that upon our analysis. Then move to the prescriptive analytics. So after this is known, this is when we build models to actually regulate these activities that is happening. So we can say, okay, we are building a model where if claims of more than 500 is submitted, the model should flag it because it's not normal. Because we are always getting between, let's say, 200 and 250. If there's high one, it should flag. If there's very low one, it should flag it. So that's what happens with the prescriptive analytics. So some years back, NHIA was doing manual submissions of claims, where we were doing the paperwork mostly. But now, we have a backbone for fraud detection. I mean, the manual claims was giving us excessive fraud, inflating our claims. We were paying more claims than necessary. Then we had this baby, Claimit. So what is Claimit? Claimit is a software platform developed by the NHIA for health providers credentialed under the NHIA to generate and submit claims electronically. How does this work? So in the Claimit, there are systems in it already to guide health providers when they are submitting claims. So this reduces a lot of fraud in claim submissions. Health providers, they generate it from their end, submit it, and make sure that the claims have the necessary particulars, the biodata, the services rendered, the diagnosis, the cost, etc. If some of these are not conforming with the operational, with our operations, I mean, the system cannot even allow you to submit that claim. So the software validates the data against NHIA's rules, as I said. So if you are submitting and the diagnosis is not valid or the member number is not valid, the claims will not even go through for vetting or payments. So this is guiding most of the providers, and it has reduced our fraud by a high percentage. And when the claims hit us, with this software, the claims have already been grouped in facility origin. It has been grouped according to IPD and OPD, etc., which makes the analysis very easy for us to do. %, but Claimate has been able to adjust our fraud with approximately 17%. Unfortunately for us, all providers have been enrolled on the Claimate. So 100% of our providers are now submitting electronically. And with this Claimate, it has made it for us, the data analysts, to identify usual claims trend across regions and facilities. We're able to detect duplicates, inflated or medically inconsistent claims very easy. It's easy for us now to build machine learning and statistical models. This validation is done right at the point of submitting through the software. And once it's submitted, these claims are benchmarked with standard performance or expected performance. Is the OPD-IPD ratio as expected from this provider? Are the claims this provider submitting expected? So when this benchmark is done, we perform the trend analysis. If there are any suspicious trends and anomalies, a trend analysis or anomaly detection is done. And after this, these suspicious claims are flagged for further verification again. And after that, if there is a need for our model to be adjusted a bit, that is performed at the end. It doesn't end there. Even when this is done and payment has been done, we still have post-payment detection process to be done. The fact that you've been paid does not mean you are free to go. You can be penalized even after payment. Or the suspicious claims for further investigation. How are we able to do all this? We use our statistical and visualization tools and machine learning techniques. So with statistical tools, NHI rely mostly on the R programming, Python, Excel, Power BI, Tableau, etc. And in machine learning, we use the network analysis and isolation for this. So you realize that there was some sort of suspicious fraud going on in our data. These providers have the same ownership, one located in Yendi in the northern region, the other located in West Akim in the eastern region, another branch in Ashaiman, and another branch in Katamantu. So you'll be surprised how someone visiting a facility in Yendi is being referred or visiting the Katamantu branch with the same condition. Why travel that far? So we are made to question if there was a genuine referral or they were just sharing claims. And it gets interesting between Ashaiman and Katamantu, probably because they are closer. You realize there's a movement of claims of about 2,423 from Katamantu to Ashaiman, and about 2,300 from Ashaiman to Katamantu, which means they are probably sharing claims for their own benefits. And another example is the next slide, where we use process mining to detect service utilization pathways. So this example is highlighting on maternal care or delivery. Normally, you get a pregnant woman attending ANC and moving to the diagnostic-related groupings for these conditions. So here you're able to tell how the movement from ANC to delivery to wound dressing, or ANC to delivery to OPD, and the child also assessing healthcare. When we expand these connections wider, we'll be able to tell the conditions specifically that a pregnant woman assessed when they went to OPDC. So if there are other conditions that are not really related to the pregnancy, we can tell and prove for further investigation. And as actuaries, our job is to tell the financial story of institutions or our clients with data. So what happens if the integrity of our data is questioned? Then our story changes. It affects it distorts our claims, it affects our pricing, reserving challenges, and predictive modeling. So there is a need for us to actually work well together with data analysts, or even if you are working ourselves, building data analysts and AI tools to assess our fraud in our data to make better projections. But all these come with certain limitations. We find false positives in our modeling, that is flagging innocent providers and penalizing them wrongly. And fraud statistics evolve quickly. So there is a need for models to be updated frequently. And there are some operational challenges too. There's a high cost of advanced data analytics systems, the need for adequate skilled staff, that is more data scientists. And there is still the need for human review. Even after all the tools and the AI, everything is used, there's still the need for human review alongside these analytics. To conclude, data analytics is a powerful tool for uncovering hidden fraud patterns in health insurance. By scaling our electronic system, leveraging on machine learning, and exploring blockchain, the NHI will reduce losses and enhance sustainability. And there is a call to action for actuaries to lead in embedding analytics in risk management frameworks because they play a critical role in quantifying risk and turning analytics into actionable strategies. Thank you.
Thank you very much. We would want to take some questions. We all saw the data. I would have been surprised if I've not seen Ashaiman in the data. Yeah. Please, any question for... Any question? There's one here. So the microphone, the phone is coming around, please. Any question or input, anything you want to ask?
Hello. Yeah, my name is David Lawrence, Salam Alliance. I just want you to elaborate a little bit on the provider shopping being classified as a fraud. And also, when you did the graph, we saw the numbers. So what detail or further work was done to conclude that it was fraud? Thank you.
Thank you.
So we will take the next question so she answers all at once, please. Is there any other question? We have the representative from the UG ask questions.
Okay, thank you for your question. So provider shopping is when a member moves from facility to facility accessing service in a particular period. So let's take today, or a specific day, for example. I go to facility A to access healthcare. I move to facility B, maybe in the afternoon, thinking that facility A didn't take care of me well, and I feel facility B will be better. I'm still not satisfied. I move to facility C, and on and on. That aside, there are some members who know that giving drugs using our...
If I may ask, how can you conclude that that's a fraud? Some people are not psychologically up there, so they're just trying to find a doctor that would say something to them that one way or the other will make them feel good. So it's not necessarily fraud, unless you know that they're selling the drugs they're getting or something of that sort. Why would anybody waste their time to go see another doctor?
Suspicious fraud. Based on suspicion. But we investigate further. We visit some of these facilities also. Yeah. So it goes beyond just doing the analytics in the office, but we visit these facilities also to investigate further.
Okay.
Okay, thank you. On the provider fraud, if the provider issues a generic drug to the patient and end up billing you using the branded, how are you able to detect it?
The claims cannot even be submitted. It's generic. So we have our medicine codes that we work in. So the medicine that you are submitting your claim has to come with a code. So we don't use generics for payments, but the code, unique medicine codes. So every drug has a unique code. So, and we pay based on generics and not brands.
Branded. Okay,
Yeah.
thank you.
I'd just like to have an idea as to how much savings made due to all these systems put in place. If in terms of quantity, amount per year, if you have that data.
Yeah, according to the data, we make about 10% savings. Yeah, 'cause this is based on the deductions made by we have a team called the clinical audit team. And based on the data, we save about 10%. Yeah.
There's a question. I think we take two more.
This is Bryce here. Thank you for your presentation. It's a very beautiful system you have in place. What would you say is the success rate of the claims that you determine as fraud? In other words, like false positive, are there claims that you detect as fraud? Then you look into it, and then it turns out, no, it is not.
Yes, they are. I cannot really tell the exact percentage of that, but yes, we do. So
Okay,
with
great.
the first diagram I showed where Ashaiman and Katamansu were sharing claims, you find Ashaiman in Greater Accra and Katamansu also near Greater Accra. And that's an example of what you are asking happening over there. Oh, thank you.
Please, let's give them a round of applause. Thank you very much, Marian Tando from NHIA. At this point, we want to slide the curtain on the first part, and right from here, we'll be having a cocoa break. I know actuaries always appear to be serious. Please, let's take it easy with the coffee when we go out there. And ASG Executives, GIA President, NIC Rep, UNDP, African Re, SOA, CAS, QED, or our partners. Mark. Please, which of the cameras are they looking into? Okay, so you can smile at this man. Please, let's... You see how complex it is to organize actuaries? Please smile. All right, so we are reconvening at 11. Enjoy your break. Thank you.